The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
It's Friday, everybody. Well done. You got past the Fed decision and plenty more besides. This is Squawk Box, and I'm Steve Sedgwick, and these are your headlines. Well, how about that? US markets see their best day in 6 weeks as tech shares tear higher, with Wall Street cheering the Fed's bumper 50 basis point cut. China's central bank, though, keeping rates on hold, bucking expectations for another cut, whilst the BOJ also stays unchanged, upgrading its outlook on domestic consumption. Mercedes cutting its margin outlook for the second time in less than 2 months, blaming weakness in the key Chinese market. And France's Prime Minister getting set to present his new cabinet picks, hoping to end months of political deadlock after elections delivered a hung parliament. Got a lot to get through, good morning to you all, by the way, including the fact that the US markets, well, they really did surge yesterday, and I'm not entirely sure why. I keep reading the rhetoric and the copy and watching excellent channels like CNBC, including CNBC, and I'm not entirely sure that I've read anything that justifies the rally. Maybe it was positioning ahead of the Federal Reserve. People were very cautious about what they had to say. This landing stick people keep talking about and how the Fed is going to try and land without a recession. But when you look at where the leadership was as well, you could make a very good argument for the others. For instance, tech. This wasn't about tech companies struggling to refinance. This was about the big players rallying hard. Well, hang on a second. They haven't got refinancing worries as well. So why should they care about the larger than expected from some quarters rate cut as well? The banks were another great case in point. JP Morgan up 1.4%, rallying hard as well. I'm thinking, well, hang on a second. Some of you out there, by the way, erroneously, some of you guys saying out there, well, no, but the NIMs will be lower if we have lower interest rates. Well, it doesn't actually work like that. But anyway, you go with your line. And that's why it's not so good for the banks when we have lower interest rates. JP Morgan was up 1.4%. And some of the retail stocks, I get this a little bit more, perhaps. That's where the logic is. Home Depot putting on 1.7%. Caterpillar, actually, that was interesting. They were up 5.1% as well. So it was a very broad brush rally. But of course, bit of impetus on those technology stocks, which, as I mentioned in the headlines, had this fantastically large rally. Treasuries look like this. Let's take a look at where the 10-year is trading. 10-year, 3.7%. By the way, some of the data yesterday, did you see it? It was all right, wasn't it? I know you're all obsessed by talking ad infinitum, as indeed I've had to do, about the Fed rate cut. But also we had the Philly Fed. That was all right, the headline figure. If you go into the weeds under the hood, it was more nuanced. But the headline figure was pretty good as well. Jobless claims, there's no great expansion of joblessness there as well. So the data was actually pretty solid as well. What's the dollar doing on the back of this? Well, actually, for the week to date, I had a look at the dollar index, and I can tell you it is down 0.5 of 1%. In fact, week to date is probably a better way that I can tell you about a lot of things going on as well. Shall I just do that very briefly as well? So week to date, the markets have digested decent gains, 1% plus for the major indices, sectors, it's technology that's been the outperformer, consumer staples. And here's one for you. If this was all about the consumer having a better outlook on the back of lower cost of money, on the back of a bigger than expected rate cut, then why were consumer staples underperforming yesterday? You'd think it was consumer staples would have had a jolly strong day as well. Again, just some of the anomalies in the market. Let's move on to commodities as well. A lot of people have been talking about gold as a great safe haven, $2,600, give or take, per troy ounce. Oil has been fascinating. There's no doubt about it. Real concern about oversupply. It's actually about demand, isn't it? This isn't about the supply in the market. There's plenty of supply. This is about the demand out of China, out of other economies if we hit some form of recession. And the fact of the matter is we've drawn a line in the sand on recent declines for the moment. For the week, both Brent and WTI up the best part of 5% coming into this session. Asian indices, my team tell me they're going great guns to the upside by and large. Shanghai Composite, you'll see a little bit of disappointment about what I said in the headlines about what the BOC, the PBOC, hasn't done, i.e. making the cost of money even easier. So we're down 0.2% on Shanghai Composite. Elsewhere, solid gains out of the Nikkei, regardless of what the BOJ said, and the Hang Seng up 1.3%. So I'll go into that China story in a bit more detail for you. China has kept its benchmark lending rate unchanged. That's a decision that caught some markets off guard after the Fed's big rate cut earlier this week. A series of weaker data prints had markets pricing in a reduction in rates as Beijing seeks to boost the country's sluggish economy. Further cuts are still expected. Analysts say lower rates from the Fed gives the Chinese a little bit more flexibility to loosen monetary policy without hurting the currency, which, as you can see on the screen, and they've already put it up for me, amazing work, team, 7.0449 is where the dollar yuan is trading. Let's move over to Japan. The Bank of Japan has kept its benchmark rate on hold at 0.25% as expected. It comes as the central bank looks to normalize its monetary policy away from its ultra-easy approach, without upsetting markets or the economy. Lessons learnt over the summer after an unwinding in the yen carry trade prompted a global market sell-off. Well, who better to fill us in with all the great details? Is Lynn on one of her last assignments of the week, no doubt, before you have a well-earned holiday, Lynn?
Hello, Steve. Yes, so as you say, the rate is unchanged as what was expected, 0.25% for the short-term policy rate, widely anticipated and a unanimous decision at that. And off the back, the response from the markets was pretty muted. You've got, in terms of the yields, some slight upside in the 2 and the 10, but really it was a priced-in decision, and really the focus here is going to be on that press conference by the BOJ Governor Kazuo Ueda in about 90 minutes time to hear what he has to say in terms of the outlook going forward. In terms of the monetary policy statement that we do have, it was a short one, only 5 paragraphs. Couple of things to note here. They did raise the assessment in terms of consumer spending. This is off the back of the Q2 GDP numbers that showed that in terms of private consumption, that rose for the first time in about a year. On the inflation side of things, they said that it was still tracking in line with their projections, describing inflation expectations as having risen moderately. And in fact, we did get the August numbers coming through. That core CPI, 2.8% on an annualized basis, which was in line with expectations, a 4th straight month of an acceleration and well above the BOJ's target of 2%. However, perhaps the most interesting part of this statement is in the last paragraph, talking about the risks to their outlook, sort of this focus on the financial markets as well as the FX space. And certainly when we have spoken to our analysts this morning about this decision, really, as I said, this was not seen as kind of any kind of a debate, but rather what was going to come in October, December and January, and markets remaining still very split. And really, I think in terms of the risk events here, it's very much the elections. We've got not only elections in the US, but also elections in Japan, with the LDP choosing a new leader and by extension a new prime minister. And potentially we could have a snap general election off the back of that. Certainly Shinjiro Koizumi has noted that that's something that he would do if he was elected, and he is one of the favourites there as well. But also, of course, so much rests on the US and the economy there, what the data points will tell us going forward, and where that will ultimately take the yen as well, guys.
Brilliant. Thank you, Lynn. Thank you very much indeed for that. And I understand that you've got the honour of coming back and Squawk Box in the next hour as well. So I'll say have a lovely weekend then. But by the way, stop showing off. You got to the last paragraph of the BOJ statement. Some of us just read the executive statement.
It was only... It was only five paragraphs this time.
Oh, that's not. Oh,
Very
all
short.
right, then I take that back. Well done, you anyway. Thank you very much. I'll see you in about an hour's time. Much appreciated. Frederick Newman is the chief Asia economist at HSBC. I understand you're in Auckland, Frederick. Nice to see you from sunny New Zealand. I hope it's sunny at least. Anyway, look, I've got so many questions for you. We've got a bit of time here, so let's start off a couple of days back, and then we'll move forward again. What has the Federal Reserve's 50 basis point cut meant for your universe?
Look, it's common refrain is advise Asian central banks a bit more wiggle room. That's really what it does. It might mean a bit more accelerated easing. But the 50 basis points is not a game changer. Really, the outlook is so uncertain. Does that mean the Fed will go harder for longer, or does it mean the Fed has come quickly out of the gate and this is going to be done pretty quickly? I think a lot of unanswered questions. And of course, the dollar hasn't reacted all that much as well. So I think here, it's neither here nor there with the 50 basis points. Bit more easing room for Asian central banks, but it's not a game changer in itself.
I kind of love you for that, Frederick, because I couldn't agree more. Everyone's getting so exacerbated about it, but it was kind of like, yeah, and with the path they've given us going forward as well, you're absolutely right. More now potentially means a little bit less later on as well. But does it give any insight into their concerns about the risks to the downside? Of course, the switch, the nuanced change from worries about inflation to the more balanced risks, as they put it, worried more about the employment concerns, really. Does it have a nod to demand globally, not just for the US?
It does have perhaps a bit of a nod to demand globally, but also the complicating factors, so maybe the political calendar that led them to move a little bit more quickly, or it might be some of the numbers I see on the employment side in the US, which is part of the Fed's mandate as well. I think they're buying themselves a bit of insurance here with a 50 basis point move. Interest rates are very high, so 50 basis points isn't really, it's kind of, you need 50 basis points to really move the needle anyways at these levels of interest rate. So again, hold your horses if you think this is a game changer. This is perhaps a bit more than expected, but the outlook remains really debatable as to whether the Fed has a long way to go or whether the Fed will quickly find in 2025 that actually the economy isn't in as bad a shape. And some of the recent retail sale numbers, I think, in the US still point to the direction that actually there's still a bit of juice left in the US consumer spending. Of course, that's good for exports and for Asian markets as well.
In terms of, let's go to the Asian markets, absolutely as well. So look, we've had no move from the PBOC, a little bit of a surprise. No move from the BOJ, probably expected, but we're auguring perhaps hikes to come at some stage. Do you want to take whichever one of those two you want to lead with, and then we'll ask the other one later on?
I was going to say one central bank did react before the Fed even moved, as the Bank of Indonesia, but let's focus on the two big central banks in Asia. Of course, the PBOC is having a bit more room here to ease rates, but they're not going to come out immediately and use that wiggle room. I think you're going to see that in the next few weeks. They're never going to move exactly right after the Federal Reserve. They want to see how the dust settles first. And with the BOJ, look, the BOJ is probably central bank where the Fed's move this week really complicates the outlook because they're itching to hike in Japan. We just got inflation numbers again showing fairly decent price pressures. But if they hike now, then they probably would just strengthen the yen. And that's the last thing they would want to see at the moment. So their hands are tied a little bit by the Fed moving more aggressively, and they just push back the rate hikes. They will have to go very, very easy in Japan. So softly does it for the Bank of Japan going forward.
Extraordinary world where you've got, policy divergence, i.e. Fed cutting, PBOC keeping unchanged, Bank of England keeping unchanged, but that's another story. And the Japanese rising as well. Does this have big ramifications for the currency? Of course, we saw that incredible rally in the yen earlier this year from those lows around the 160 mark as well. Do you augur more oscillation like that, or actually are we in a calmer zone now?
Well, that is, I think, for Japan, the biggest risk is FX volatility. And that's why the BOJ will have to take this into account, what the Fed did. It will have to defer interest rate hikes. And again, the weak yen was part and parcel of Japan's reflation strategy. And now if the yen appreciates, that really upends things. So the BOJ will have to walk very, very slowly. In other markets, though, don't forget, yes, the Fed is cutting interest rates, but that doesn't mean you're rushing to buy Chinese yuan or euros, because these economies are not showing really signs of monetary tightening. They're not showing signs of great investment returns at the moment. So the dollar remains actually fairly well supported, even though the Fed is cutting by a bit more than people had penciled in this week.
Look, you're in Auckland. Might as well ask you what's going on down there as well. RBNZ cut in August to 5.25%. Concerns that they need to get the interest rate lower. The economy is finding it very tricky. I guess that's partly due to some of their export markets being under pressure. Just give us a quick rundown on New Zealand for our fantastic New Zealand friends and our supervising producer.
We have still a bit of a rough patch here in terms of the cycle in New Zealand, and clearly the RBNZ is on course of easing more. They'll be cutting interest rates because growth for 2 years has really gone nowhere. GDP is a bit lower now than it was in 2022. Inflation has come off, and so they'll be cutting. It's different across the Tasmanian Sea. The RBA may not be cutting until the middle of next year because their inflation is very sticky. So they're going to sit tight and wait until at least the middle of next year before they cut interest rates.
Brilliant. You're addressing something which we don't do enough, which is focus on the New Zealand market. So thank you, Frederick. Have a lovely time in New Zealand, and we'll see you again soon, no doubt. Frederick Newman, who is the Chief Asia Economist at HSBC. Briefly mentioned the Bank of England. It held rates at 5%. I think we knew that one was coming, didn't we? It was an 8-1 decision with the Governor, Andrew Bailey, saying most members of the MPC think a gradual pace of easing is warranted. It says here it's in contrast to the Fed, which announced a jumbo half-point cut in Wednesday. But of course, we started ahead of them, didn't we? Quantitative tightening was where all the excitement was. I'll try not to bore too many of you. I've got lots of reads on this in the next hour. It's important. Quantitative tightening was kept at £100 billion over the next 12 months, with the bank saying the programme has proceeded smoothly. UK consumer confidence, meanwhile, from GfK, shows that consumer confidence has plunged in the UK. Well, we'll come to this in a few moments' time. Consumer confidence has plunged in the UK, down 7 points to -20. That's the lowest level since January, and comes amid warnings from the government that this is here's a question. Let's get in vision on this one. If you're the Prime Minister, what's your job? To be honest with the British population? Tick. To tell them about the challenges ahead? Tick. To make us all utterly miserable for the next 7 weeks about how painful the budget's going to be? Debatable, because it's the Prime Minister, isn't it? Sir Keir Starmer, who's been telling us all how painful it is. And that was cited by many people as saying, well, why the British consumers just, whoa, if things are going to be painful, if my tax take is going up, if my inheritance tax is going down, if my school fees are going up, if my council tax is going up, etc., 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 to quote the great Yul Brynner, you're not going to spend as much money, are you? And you're going to be a bit more cautious. Not saying the government shouldn't be honest with us. I'm saying maybe there are some ramifications from their rhetoric and their language. Anyway, we'll see. Meanwhile, coming up on the show, more bumps in the road for Germany's automakers. Yeah, horrendous actually in some ways. Mercedes now cutting its guidance. Plus Nike ticking high, didn't tick high, it surged 10% at one point. This following the departure of the CEO, John Donahoe. I've got an old Nike insider coming back again. Will it bring a much needed change in fortune for the sportswear giant? And we're going to run through stories and many more stories when Squawk returns after this short break. Right, is peace going to break out between the EU and China over a lot of these subsidy concerns? Let's just wait and see, hey? Because the EU and China have now agreed to further talks as they look to reach a deal that would avoid the imposition of tariffs on Chinese-made EVs. That's interesting, isn't it? The EU Trade Commissioner Valdis Dombrovskis said the two sides would look again at the use of pricing undertakings after a Chinese proposal was rejected by the EU. Now, Dombrovskis has reiterated that the probe was based on facts and ensuring a level playing field. Canada announced last month it would impose a 100% tariff on Chinese EV imports following a similar move from the US. The trade minister told CNBC it would ensure trade between the two countries is fair.
We have seen overcapacity. We have seen over-subsidization in this by China, which distorts that level playing field. And Canada's response here is to ensure that we are building out a vibrant automobile sector in the building of electrical vehicles and its supply chains. And this action is something that is responsive to the needs of Canadians. But I would also say it responds to Canada's stance always as a fair trading nation.
Meanwhile, Mercedes has cut its full-year profit margin outlook for the second time in less than 2 months. What's the shares down? It's 6% lower year to date. Second time in 2 months, citing a hit to sales in China amid slower than expected growth and the real estate sector downturn. The German automaker now sees its adjusted return on sales between 7.5 and 8.5%. That is down from the 10 to 11% previously expected. Well, the German finance minister, Robert Habeck, says the government is considering ways it could support Volkswagen, with Reuters quoting government sources as saying Germany will look at options to boost EV sales. This as the car maker prepares for talks with IG Metall, the union, over a new labour deal after the car maker scrapped a decades-old guarantee, with the threat of strike action looming. Anetta, the data yesterday, and our colleague David gets very excited about the ACEA data, the automotive data. Let me just go through the numbers one more time. Electric sales in the EU in August fell by 44%. That is staggering, but not as staggering as BEV sales, which are electric vehicles, in Germany falling 70%. 70%. I can't help thinking that there is a lot more that the government can do to boost domestic infrastructure rather than worrying about what others are doing with imports coming into the country and coming into the EU.
Yes, you know why that is? That this year has such a weakness in sales for electric vehicles because the government has scrapped all subsidies for electric vehicles after the Constitutional Court late last year did say this is not part of the budget is not according to the Constitution. And with that decision, which came actually overnight, the sales of electric vehicles just plummeted here in the country because people did rely on those subsidies when making those investment decisions. That U-turn from the government is now obviously a recognition that this was wrong and that actually did harm the industry tremendously, but it could actually come too late. But because what we hear now from Volkswagen is not just about this year, it's like a longer term malaise, one has to say. And also it's a story about they were too optimistic about consumers turning into the electric space. So Manager Magazine now is reporting and citing management from the meeting in Stockholm they had last week, where they are actually considering cutting 30,000 jobs in Germany. It's not just two production units which could be endangered. It's like a cost-cutting exercise all over the place. Also, headcount in the headquarter in Wolfsburg is affected. 20% of people should go there. And it's not yet clear which plants are about to be closed or perhaps partly closed. They are talking about at least one car manufacturing plant and also one component plant. It could be the one in Kassel, it could be the one in Braunschweig, but also an electric vehicle plant, just a brand new one in close to Dresden and Zwickau could be affected. So there's much insecurity. Of course, one has to say it's somehow also a game with the unions, because of course you have to be very bold from the management side to at least achieve a compromise, because as we all know, the unions are very, very strong at Volkswagen. And also the federal state of Lower Saxony has a 20% stake in the supervisory board and can say no to everything.
Thank you, and thank you for that report. That's excellent. We'll move on from here. We'll see you a little bit later on, Annetta. Carsten Nicholas, MD at Teneo. Carsten, if I was in Beijing, I would be really confused about what European policy is. Because you've got this hard line initially from the likes of Valdis Dombrovskis and the Commission, and yet you've got the Spanish and you've got the German auto manufacturers and a whole host of other people saying, oh no, we shouldn't have done that. We shouldn't put tariffs on top of the German EVs to such a degree. Our policy looks confused.
Yeah, and you can even add to that picture, and you look into German politics specifically, and you'll see that the Chancellery, led by Olaf Scholz, the Social Democrat, is indeed very skeptical of those tariffs and is letting everybody in Brussels know about that. But his vice chancellor and economy minister, Robert Habeck from the Greens, seems to be much more open to that. If you look back to some consultative votes that the Commission has held in July, preparing for those talks with the Chinese side, the Germans actually abstained, but then behind the doors are trying to work the phones to get enough countries to perhaps at least vote for a delay in those tariffs. So yes, but look, I mean, this is a usual feature in European policymaking. You have various different interests at various different levels, and you need to see where we ultimately get with that in terms of compromise.
Yeah, and look, I'll ask you one more question about the German government, because I like to say the word Schuldenbremse, which is one of my favourite words. Germans have all the best words, but Schuldenbremse being one of them as well. They just seem like they want to grow their economy. They want to reinvest. They've got to, and yet they've got these debt breaks which put these constraints on Germany reinventing itself.
Yeah, if you like Schuldenbremse, here's another one, Black Zero, right, which is basically taking that to extremes. That is, of course, those are the policies that Germany implemented in the late Merkel years, guided by the late Wolfgang Schäuble as finance minister. Look, politically, we have to simply go through another election, which is due in another year, where we need to answer that question against the backdrop of everything that's been going on in Ukraine, in geopolitical tensions with China, in concerns about American politics, and so on and so forth. Where exactly is Germany going to side in those debates? Because if you look at the actual fiscal space that would be available if you wanted to do more on the investment front, yes, that's available. But do you focus on another round of supply side reforms, early 2000s style? Is that your focus? Or are you saying, no, we're going to leverage some of that fiscal space for public investment? That fundamental political question hasn't been answered. We need an answer to that. And unfortunately, we need to wait another 12 months for that.
I wish you were right. I wish when we had an election next year, whether it's Merz or whether it's Scholz or others, we can get to a conclusion of this. But the problems are bigger and as beautifully typified by an Italian, not a German, and this is Mr. Draghi. And I can't see whoever's leading a German coalition, whether it's some grand coalition or not, whatever, agreeing to 350 billion euros of remedy in common debt, part of the remedy, at an EU level as well. It just doesn't feel very German, Carsten.
No, it doesn't. It doesn't. And therefore, I fully agree with you. We're not going to get to those numbers in one big political decision overnight. Definitely not. I think the point of big reforms, big reports like the one issued by Draghi is actually not that. I think the point about that is more setting the tone of the conversation for that new commission over the next 5 years to come. And if you look at the composition, of commissioners that we've seen there, from Ursula von der Leyen coming out now over the last couple of days, I think you already see this kind of competitiveness focus, structural reform focus, cutting red tape focus as this kind of macro theme that is basically everywhere in this setup. I think you're looking at a longer term big deal here, ultimately, as always in European politics, between Germany and France. Are we willing to move more into this kind of like structural reform direction, completion of capital markets union, these kind of things that Germany would like to see? To the degree that the others are moving in that direction, I think with the new government, perhaps the German position could soften a little bit, even if we're not looking at a new big, let's say, post-COVID style fund overnight.
Yeah, well, I hope the Germans have better luck negotiating with Barnier, who's the new Prime Minister, than the British did anyway. But moving on to another issue as well. Okay, well, actually, no, let me tie it all together. So you've talked about the Black Zero, the Schuldenbremse, the debt break, plus that the union pressures to not lose jobs and to kind of not have this reinvigoration the likes of Volkswagen want to see, plus the contention between Berlin and Brussels. Where does it leave us in terms of our relationship with China, which I think was one of the things you were booked to talk about as well? Can you see a path through this?
Yeah, I mean, if you look at the outcome of those talks yesterday between China and the European Commission, I would argue that if you look at this from the perspective of somebody who's concerned about the imposition of tariffs, then I think the outcome of yesterday's talks with those price undertakings is actually more positive than what many had expected going into those talks. So to the degree that the Europeans are perhaps willing to consider things such as certain minimum prices, perhaps certain maximum quotas, those were things that a couple of weeks ago, the Commission was very adamant they wouldn't want to look at. So it does seem that this kind of carrot and stick approach that China tends to apply to European member states, you mentioned Spain already, right? Joining the skeptical camp now inside the EU when it comes to those tariffs. It seems that seems to have worked to a certain degree. So we really need to wait until the very last moment here. That crunch vote on the European side is obviously not due before the end of the month. So we still have a couple of days to go for that.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to cnbc.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.